Should we show it to this?
So that's one, and then this is the actual platform, and then, yeah, okay.
Some people are coming in. Okay. Hello, everyone. Hi. Hah? Dalam? Iya, dari boleh suruh kok. Ini boleh mulai kan? Boleh mulai. Itu susah pembukaannya. Okay. Hi, everyone. We're going to start with the event today. So it's going to be a fundraising bootcamp by Matt vitamante. Did I pronounce your name right?
Very good.
So it's going to be an hour talk. So if you guys have any questions, just feel free to ask away. We're also going to be recording it on the YouTube channel. So if you want to check that out, the link is also in the Dojo Community Facebook group. And if you also have any questions you want to ask Matt after the event, feel free to stay afterwards and stay in the meeting room to chat. He'll also be here after the talk. And that's it for me. Hopefully everyone enjoys. Thank you.
Yeah, thank you. So this is live? It's on, okay. Hello, Matthew Vitamante. Currently splitting my time between Canggu and Singapore. Originally from New York and California. I've been living in California for probably 20 years. The CEO of California Global Innovation Exchange, which is a SaaS platform focused on institutional grade venture capital, private equity, and corporate venture capital financings, M&A, etc. And I kind of want to just script it so that I give a little background about myself, a couple of talking points about what, in my experience, what I thought was important for fundraising, capital raising, and then I'll show you the platform that we have, and so you can kind of put it all together. But if you guys wouldn't just raise your hands if any of you have raised venture capital money before. Venture capital, private equity, angel investor money. Okay, painful, right? Yep. Yeah. Okay. Anybody planning on doing it? Okay. All right. Good luck. So it's one of the most arduous and painful parts of a startup. And a little bit I'll give you a little background first. So I ran the Credit Suisse technology banking desk in San Francisco for 8 years, Société Générale's desk in Paris, and then I came back to California to run the private equity sustainable clean technology investments. So really, I'm a hippie at heart, and you know, we can use capital and technology to help clean up the earth, and so that's kind of where part of the reason why I'm here in Canggu, and I'm potentially going to be doing some stuff with the Chamber of Commerce, etc. All right. So CAGIX, California Global Innovation Exchange, was built out of the Los Angeles Clean Tech Incubator, which is the largest incubator space, largest commercialized business incubator. We have 49 portfolio companies, and we built this right after the financial crisis because we knew that the banks weren't going to lend to early stage investments. They don't know how to invest into early stage investments, and that private equity, venture capital, family offices, ultra high net worths, investment banks, governments, all have a different understanding of what it takes to be educated and to engage in early stage investing and even growth stage type companies. That we just did a deal with Black & Decker, and their learning curve on investing into the company that we were working on was very high. And so you would think like Black & Decker, Caterpillar, they're the oldest brick and mortar companies in the world, and they should understand how to invest, but they don't. So, so we built this platform as a way for all of the stakeholders that I mentioned, the venture capital, all the types of investors, for them to be educated. And the more education that, and the more that everybody's really up to speed, the better the chances that the good companies will get funded and that there will be a clear strategy. All right, just a couple of simple concepts. The pitch. So I like to look at it as the non-pitch pitch. And if you look at the word pitch, the pitch means to come at an angle, right? So if you're surfing down a face and the pitch is too steep, you're going to nosedive. If the pitch is too flat, you're not gonna move. And so investors want to know, really at the end of the day, that you're being straightforward with them and that you have enough confidence to be able to share what the blind spots are, where you need help, etc. So I use the term pitch generically, but if you're going to start doing your own fundraising campaign, it would be really important, really important to not say, here's my pitch, because the investor goes right into defensive mode. And investors are paid to be skeptics. So please understand that what you want to do is develop a relationship with the investor, no matter where your fundraising campaign is. And how you want to present it is that this is my value proposition. Here's what we do. Here's what we want to do. Okay. So use the pitch. The pitch is a generic term, but you never want to say, here's our pitch. Okay. Second, attention deficit disorder. Every investor has ADD, just along with all of us, right? We're all plugging away, programming, doing whatever we're doing on tech. Investors have attention spans of 30 to 45 seconds. So as I backpedal a little bit about the pitch idea, what you really want to do is capture what is your product? What is the value proposition? What was it about you that somebody caught, that investor caught their eye? They sensed a sense of confidence. They sensed humility and humbleness. Okay, so after 30 seconds to 45 seconds, you can actually tell if the investor really cares or not. And he'll start dwindling off and looking at his other way, looking at his iPhone, and yada, yada, yada. So these are just little talking points to kind of remember as we go through the platform. Okay, so everybody know what ROI is, right? Investors, there's different types of investors. There's strategic investors, investors that don't care about the ROI. They care about your technology and they may buy it. Some strategic investors want to test your technology. So we have Black & Decker and Caterpillar testing our green technologies. Those are the types of groups that you want testing your companies, right? Because those are the companies that have the most structure. And then you've got the financial investors, and they only care about ROI, right? So they're going to be leading the round. They're going to be leading the financing round at a valuation. So if you're raising $5 million in a Series A or a seed round, that financial investor is going to price the deal, and strategic will come in. All right. Does everybody know all the stages? So there's seed investing. There's friends and family investment, usually somewhere between 100 and call it 350, 400,000. Then there's seed investments, $500,000 to $1 million. And then you get to the real price round. So the Series A and up. And each round, subsequent round, and anywhere from Series A to Series D and E, those rounds get bigger. The valuations get bigger. The revenues get bigger. Actually, take that back. Revenues sometimes go lower depending on their growth stage. And so I'm assuming that most of you, since you're just starting out, you'll be doing a friends and family round. You won't need to be as sophisticated, but remember they're your friends and family, so don't lose their money. Uh, you go to a seed round. If you go to a real structured round, a Series A, my advice is to not do it yourself. My advice is to get a financial consultant or a venture capital consultant or a coach to do that for you. And we at Kajix, that's what we do, is we help coach early stage companies that either have a really good idea and they need incubation. So they need to be incubated. The idea needs to be incubated. Or there are companies that are Series A, Series B that want to do another round but don't know how to, right? You want to make sure that you're getting taken care of by the right people, because financial investors will take you for everything that you're worth. Alignment. It's really important to be aligned with your vision. So for me, knowing that I'm a tree hugger and a hippie at heart, I'm not going to be raising oil and gas type technologies, right? I'm going to be interested in clean tech. Investors and even your team, all of your stakeholders, it's really important to be aligned with your value proposition, your vision. Everybody's got some sort of vision, and everybody has ideas. There's a million ideas out there. The question is, can you build a team around that idea to create infrastructure and support enough for you to be able to raise the real capital to then execute that idea? Sandbag your financial projections, especially to your friends and family. So if you think you're going to make $100 by Q3 of 2018, knock it down to 10. Same thing with your professional investors. Underperform, over deliver, because real investors, as you go along, you project that you're only doing $100 by Q3 2018. They're going to say, no, actually, you're going to do 500 if you look at these metrics. And so they're going to invest right away. Once they feel that you're being conservative enough, there's this sort of balance between getting an investor engaged and being conservative and realistic enough to make sure that he trusts you, not only in this fundraising realm, but the next rounds and the next rounds. And all of us here, whether you're a programmer, whether you're a designer, one way or another, whether you're part of a company, whether you're just a project manager, you'll always be around capital raising. If you get really good at being able to do this, you can create a fund around it. Like Dojo, for instance, is a great opportunity to be able to see what's under the hood here. There's a lot of great ideas. I've met a lot of great people. We're actually talking about putting together a fund, a small early stage fund for the Canggu area and a couple of the other work stations. But the reality is you want to be able to speak the venture capital language, because then it'll show a bit more of a credibility. Always work in progress. Fundraising is capital raising, doing deals. It's always a work in progress. Just when you think it's done, I've been working on a deal with a large Singaporean venture capital fund, and they're Chinese, and we're very American and very California, and it's been going on for the last year. And when they said it was going to be done in August and September, it's an ongoing process. Don't give up, and just hang in there. Investors take their time. Cap tables. I'll show you guys a cap table later. Capitalization table is if I have 100% of the company, right? How much am I, if I'm the CEO or the founder of the company, if I own 80% of the company, what does that say to you guys? It says that there's trouble. One, either I'm a control freak, or I'm trying to dominate the world and I'm not letting anybody else in. The cap table is like, the expression, picture's worth 1,000 words. A cap table shows the investor, shows the community, shows your stakeholders that you have a team, that we're set certain goals, certain MVPs, minimum viable products. So We work with, so when we built our platform, we built a cap table, which triggered rewards around meeting certain MVPs. And within that, we would then trigger more equity to our team so that everybody was holding their weight. And if they didn't hold their weight, they didn't get the equity in the company. And having ownership of the company and having your team part of the exit, of the whole sauce of it, is the most important thing. So the cap table is really important to have a nice, healthy balance. Now, sometimes if it's too healthy, then when the investors are coming in, they're going to say, well, how much? All right, I'm going to invest $1 million. And we're like, well, we only have 5% left or something. You're going to have to ratchet it down to everybody. You're going to have to make room for everybody. But first and foremost is when you go to your friends and family, when you go to your, you do your first round, make sure you have like a team to support you no matter what you're doing, because you can't do it on your own. And even if you are the superstar and something happens to you, at least you have somebody to fall back on. All right. Any questions to start? Yep.
What does the cap table typically look like from seed all the way to Series C and D in terms of the investor portion versus founder portion?
Yep. Good question. So the cap table is all, you have to assume, and you have to tell your friends and family and the early stage investors, they're going to get diluted. Right. So if you do make it to the Series C and Series D rounds, they're $1 million investment, which was, let's just say 20% of the company, will be diluted down to 10% or 5% by the time it gets to a later stages of the round. Dilution is just part of the investor process. You can put anti-dilution clauses in there for the investors, but the reality is if they're getting diluted for the right reasons, it's a good thing. If they're getting diluted for what's called a down round, meaning that you did a round at a valuation of $50 million, and then the next round you did a valuation of at 25 million because you had a bad year and you need more capital desperately, everybody gets squeezed. So that's a good question, and we could talk about that later on, and I can show you the different types of metrics that all of that happens. Any other?
How do investors feel about dual class shares that let founders keep control of the company as they get diluted?
Which class?
Dual class shares, like
dual class.
10 votes to 1 share type of thing.
Like founder shares.
Yeah.
Yeah, I mean, I think it's important. Investors want founders to be successful. The key, and here's where I've seen a lot of good companies and a lot of good deals fall apart, is where the founders got too greedy and said, no, I'm not gonna put a restriction on this and that. Get the capital in the door. Let the just get a deal done. And when investors get a bit, founders get a bit overzealous and overambitious sometimes. Work with them, negotiate. The key there's a good question. The key to all of this is having a really good investor base in your company. So, fail fast and you fix fast. We failed 1 million times because we're FINRA and SEC compliant, and we kept running into all of these different issues, and and I had to keep calling my investors saying, hey, we have a problem here. We're going to need a little bit more capital here. And, and you want to be able to have a dialogue. Don't be afraid of them. They want to see you succeed, but you have to make them part of the solution. Any others before we jump in? Okay. All right. So I'm going to pull this up. So this platform was built for institutional venture capital investing in Silicon Valley and on the West Coast. We since have expanded into Europe, as well as we're now moving into Asia. Our main partner, and this is an old demo platform. This was built in 2014, 2015. But our main partner is the Los Angeles Clean Tech Incubator. And so they have all of these great technologies, and we help advise them. We act as venture capitalists, and we help act as angel investors and investment bankers. And what we've done is we've allowed for certain groups, such as Lacey, I'll go back here a second, Wells Fargo, Shell Ventures, all of these types of groups, they're all different, if you notice. And we have like another 50 or 65 of these right now. All of these guys are different. Shell Ventures is one of the largest oil companies in the world, but they have a corporate venture arm. And their understanding of deals and investments is different than Wells Fargo, which is a large commercial and investment bank. And so what we've done is we've standardized the capital raising and the fundraising templates for everyone. So for instance, this allows for LACI to present themselves to the closed circuit of institutional investors. And during the time that we launched the platform, they were able to onboard Hollywood Electrics. Hollywood Electrics was doing $1 million convertible note. I think it was a bridge round to their Series A. All right, and this is called a teaser. So when you are raising capital, you will have an investor deck, and then you'll have a teaser, and the teaser will be the one-page business summary of the investor deck. So here we have everything, what they do, the size of the round. You can follow the company. You have access as an investor to their investor presentation, financials, and term sheets. It's a bridge round, and a bridge round means that in this case, they did a seed round at call it a $8 million valuation, and they needed a bridge note, basically a bridge loan. And usually those bridge loans allow for them to build up enough momentum to get to a Series A. And when you get to a Series A, it's almost like you got out of the woods. It means that you're real. If you don't get to Series A, then it kind of means you're probably going to go bankrupt, or something bad's going to happen. So Series A is usually a good sign. So you have all the venture firms waiting for you at the Series A, because it means that you're real, you're valid, etc. So in this instance, we built in a video interviewing the company. You can invest online. It talks about the company. So here's where the teaser, here's where you want to take the notes a little bit. There's the overview of the company. What's the problem you're trying to solve? What's the solution? What's the market opportunity? What are the products and services that you're offering? What's the competitive and value proposition? Okay. So as an investor, whether you're doing the 2.0 version of fundraising, or you're doing it yourself, or whatever the case is, you want to have those basic things down so that people know what they're investing in. You want to talk a little bit about the team. Team is really important. Track record, right? Even if you have to, recruit somebody and they want, 30% of the company or something like that, but they're able to bring some validation to the company, and they're able to help drive the company. Tech is interesting because you're always beta testing, and then you're tweaking, et cetera. And tech startups, you have to have, it's a healthy balance of execution and following regulation, financial regulations, and then beta testing within those financial regulations to extrapolate the margins, right? And so it's the people that can find those the special sauce, like the gray areas. That's where you can then tweak and pivot your company. You can bring in more investments, et cetera. But it's very important to have a real either COO or a CFO of some sort to be able to create a bit of validation. So here you show the milestones of the company, and then most importantly is the data room. So the data room, this is where everything lies. So this company the first and the largest electric vehicle motorcycle company in the world. We did a $1 million round for them a couple of years ago, and they're now going to a Series C, and we're now going to expand them into Vietnam and into China in 2020. All of this stuff here is what you really want to focus on to make sure that you have. So everybody uses Dropbox, I'm assuming. You can do this in Dropbox. What we've done is we formalize this so that an investor, I think we've taken down all of the pertinent information, but for instance, an investor can pull down, I'll show you one of the investor decks shortly so you can get a sense of it. But here they can get a sense of the investor presentation, the company overview, the company strategy, R&D, products and services, operations, anticipated capital needs, intellectual property, licensing, partnerships, financials, the pro formas, management, legal, and other. And there's a lot of information there. Now, most important, when you get to this stage, and if you get to this stage, first of all, you always want to get an NDA. Everybody knows what an NDA is, right? Non-disclosure agreement. You always want to make sure that the person that you're speaking with it's amazing. The startup world we've had investors come in, invest in the company, and then we found out they actually are a competitor under another, holding company and stuff like that. So make sure you always get an NDA first and foremost. The documentation is really important. If you can show clear, crisp, professional documentation, it's really important. We built this with in collaboration with investment banks in the US. So this is under the FINRA, the Financial Regulatory Authority, which is the most stringent financial regulatory in the world. And so we knew when we built this there and we got approved that we could use this as a template throughout the whole world, because most of, like Indo is very loose and very relaxed with their financial regulatory authorities. Maybe we get in trouble if we set up shop here, but in Singapore, that's what was interesting for the Singaporeans. And we're going to do the same for Hong Kong. So the key to all of this is that nobody has standardized private equity and venture capital from a financial regulatory authority. Venture capital has always been the secret world of venture capital and who's doing what behind what. And you only hear about things after the fact, right? What we're really interested in is using the financial regulatory authority as a way to standardize the whole market, because I'm sure some of you guys are stock investors in the public equity markets, et cetera. It's so hard for investors to make money now because the margins are thin, the markets are really fast, et cetera. And where investors are making money is investing in innovation, because it's not about the innovation itself. It's the fact that that innovation then licenses its technology to the corporates. All right. Any questions so far? I'm sure I've confused a few of you. So this is an engaging. Did you have a question? Oh, okay. Yep.
Sorry, mine's backtracking a little bit. I'm not really experienced in this at all. So,
yeah.
How do you determine what percentage to give away at a family friends round or a seed round or a strategic investor?
Well, that's a pretty wide question, but I guess my response would be have a professional help you with it. At the end of the day, you want to think about it as building. You're building a company. So if it means that you have the perfect strategic investor come in, and that strategic investor can help an early stage company create infrastructure, open up business development avenues, help close contracts, right? Provide a resource and sort of an infrastructure for you to operate in, you bring them in. The friends and the problem with friends and family is that friends and family usually get crushed because you then are torn between the strategic, the big strategic player coming in and saying, well, I want 50% of it, and we'll take you to a Series C and Series D, and then we'll have some sort of liquidity event. We'll either acquire you or take an equity ownership or whatever. It's kind of hard, and that's where friends and family. I would veer away from friends and family if I were you, and really go towards angel investors because they're more sophisticated than friends and family, and will be able to help guide you. Sorry, I'm not sure if I answered your question. And you never know. And it's a question of you want to have a co-founder. It's really important. So my co-founder, he ran Oracle Capital up in Silicon Valley. So it was a great co-founder for me, right? Because it then opened up doors and their portfolio companies, et cetera. I got lucky, right? And so, but you want to have a co-founder that thinks not about what you're going to give away, but what are you going to offer to your co-founder. The thing about venture capital is, and especially California is a lot different than Asia, especially. And I lived in Europe for 8 or 9 years, and Europe is kind of in the same in the middle, where I was in a meeting yesterday, and the Indonesian investor said, "So what do you want out of it?" And I didn't know how to respond because first of all, I don't see things as wanting something out of it. It's like, here's your value. What is that value worth? That's a different energy, right? So you want to be able to bring as much value into the initial proposition as possible. There's a term called the halo effect, which means that, you bring in somebody that's got a big name, and sometimes it works, sometimes it doesn't. I was going to show you actually our original cap table where we had basically the head of the U.S. Renewable Group private equity $8 billion fund as our chairman. He was great, but he was so busy that he wasn't really able to help us. And so the angel, what was it? The halo effect really didn't work for us in that situation. So, any other questions?
So if you don't live in say Silicon Valley or a hub with a lot of angels, and you don't have a personal network with a lot of angel investors, how would you go about getting in front of those investors? Yeah,
so I would say that the real question is, how do you build a value proposition and not just I think getting in front of those investors is one of the end goals. I think a step into the dojo type community is sort of a step into that, and being around and creating infrastructure, incubators, like official incubators, where they have incubator funds, early stage incubator funds. Where do you live?
Right now in Chengdu.
Oh, okay. Well, so I'd say that my experience is that Indo is early. It's still pretty early on the fund management side of things. But you want to embed yourself in that community, and then, be able to help build that value proposition. So it's kind of, to answer your question, part of the reason why we built this platform is we knew that 98% of the venture capital money was in Silicon Valley and in California. Even in New York, there's very little venture capital in New York, and it's night and day. Chicago, New York, right? Most of the early stage investment, and now, they mentioned that California is the 5th largest economy in the world. A lot of that has to do with the fact that venture capital is fueling all the technology startups.
What are the chances you can get an early stage investment from California if you're not located there?
Would you
have to relocate there to?
No, so it's, $5,000 a square foot on Airbnb to get a tent in San Francisco right now. So you don't want to do that. It's crazy. I think that getting involved with platforms like this, that's why we built. So there's other platforms out there. There's other crowdfunding platforms that, and Kajix is not a crowdfunding platform, but you can compare it to a crowdfunding platform where you want to be able to build your value proposition and then get into the areas. So Singapore, for instance, is starting to open up that world. It's still early there. Hong Kong is a great market for that, so we're going to be focusing on that. But it is difficult, and that's why, you know, as a venture capitalist, we don't see risk as risk; we see it as opportunity. And so there's a lot of great startups, you know. So I'm pretty well connected to Latvia and Estonia and Ukraine. There's incredible developers there that we're using to develop some of our platform stuff for Singapore right now. And there's like, you know, so how do you tap into that, right? And so, you know, maybe there's ways to franchise a funding platform. I think it's really important to be aligned with some sort of funding platform. How are we doing on time? 5 minutes? 25. Yeah. Okay. All right. Any other questions?
How willing are investors to sign an NDA in the same stage?
What was that?
How willing are investors to sign an NDA?
How many investors?
How willing are actually prepared to sign an NDA if someone's got an idea and wants to get?
Well, if they're interested. So, all right, that's a good question. We'll use that question and kind of role play it a bit. All right. So let's go back to the teaser. And the teaser again is the one page. It's called the summary. Now, the summary doesn't really say much. It says the first and largest electric vehicle motorcycle company in the world, yada, yada, yada. We're raising $1 million. They don't talk about anything. Now, at this stage, the management team, the founders, don't have the right to ask for an NDA. But once they say, we want to go into due diligence, we'd like to know more, the data room is where everything is showing. So for them to actually access all of this information, that's when you ask for an NDA. If they don't want to sign an NDA, then it's very telling.
How common is it actually the NDA sign? What's the action?
What's the action? You just sit.
How common is it that
Yes.
investors actually want to sign?
They don't want to sign an NDA. If they could get, I mean, if they have a, you know, that puts them at right? Like puts handcuffs around them. So if your company XYZ has an NDA ready to go, and say, look, you know, here's our one pager, here's what we're looking to do. We're looking for partners, we're looking for investment partners. But for us to then, you know, share with you our IP and how it works, or what's the demo, or what's our strategy, you're gonna have to sign an NDA. Now, treat everything with a grain of salt, even after somebody signs an NDA, because who knows where it goes from there. And that's what's the beauty of a platform, is you get to capture, everything is captured on a platform and is safe. You know, we built this knowing that, you know, if I were to backtrack, investment bankers who usually represent early stage companies or venture capitalists, right? They're there and they know that the early money, the risk capital is where they can really get you. So investment bankers will take a 10% fee or a 15% fee, charge you $50,000 to $100,000 to retain and build your investor presentations, et cetera, and have all your proper documentation. We saw that as it doesn't work for early stage companies because they don't have the capital, they don't have the resources for it. Venture capitalists, on the other hand, also will take a fund. So if Kleiner Perkins sees XYZ and they want to invest in it, they may take 30, 40, 50, 60% of the company. And they say, if you don't like it, then, it's okay. We're not going to invest. So at this stage, in 2018, there's enough companies out there that have been bootstrapping it for a while. I think bootstrapping works to a certain point, and then you hit a point of diminishing returns. So I made the mistake for Kajix. I'm the CEO of the company. I was trying to walk our talk and be as capital efficient as possible. And when the real growth came in, and we were doing white labels, and we were developing for different agencies and governments, and we had all these contracts, et cetera, we didn't have the capital, right, to actually exit. I had to then, do a project finance type stuff and pay my developers that way, to be able to do it. So it's difficult, but you really want to be able to have your ducks in line, and you want to be part of you want to be part of a bigger picture. The whole mantra of startups and really being able to expand is letting go. Because owning 1% of a kick-ass billion-dollar company is a lot better than owning 95% of a company that's going to zero. So get yourself into a much bigger environment, an ecosystem, not just an environment, but an ecosystem. So for instance, Los Angeles Clean Tech Incubator, we have 60,000 square feet of incubator space where companies can test their stuff. They're beta testing. They're working with, some of the larger corporations as pilot testers. And when you're part of that bigger ecosystem, you're not on an island trying to survive by yourself. Any other questions? All right. Yeah, I think we're good. Yeah.
Thanks everyone for coming.
Most of the industry that you've been discussing here is tech in terms of investment in
Yep.
technology. How much of what you're telling us about would hold in another industry, say social enterprise setting, something totally different from tech, or some other industry where you're looking to find funding?
Yep.
And you have investors that you need to go to?
Sure. Great question. So he was asking outside of tech, what about social innovation? And really, I think what you're asking is things that are not as tangible.
Yeah, I think that would
and
be a
value-based.
good contrast, because it's
Right.
easy when you got a product and things to show.
Absolutely.
With social enterprise, it's often an idea, something that benefits another person, but it's not as tangible as you say.
Absolutely.
Something you make.
So my short answer is technology will always be part of it one way or another. The longer answer is companies like, Isadora Recycling. This is social innovation at its core. This woman, an incredible woman, she uses ex-incarcerated people in Los Angeles, trains them to work in recycling of technology and their hardware, and then creates markets around that. Now, there's a bit more tangible stuff around that,
Yeah.
but it's speaking to saving money to the government, right? Because then what do you do? Are they contributing or are they taking out?
Right.
And so it takes a lot of exploring and access to governments that are willing to do that, agencies. So California is very socially, more so than most other parts of the U.S. and the EU. But in terms of, and it's kind of it's this. I'm helping represent one of the largest Indian reservations for a sustainable agricultural deal, and we don't have any reference to be able to figure out how do we value this, right? And that's kind of the $1 million, sort of question in a lot of ways. That's why cryptocurrencies are emerging,
Right.
Because why are we still valuing oil and the dollar interchangeably when we're going away from oil and we're going to renewable energies, right?
But you still have a population of venture capitalists or even angel investors that you can go to, despite the fact
Sure,
that you're
sure.
not selling a technology, you're selling a social.
Sure, sure. It always helps to have some sort of technology supporting the social innovation.
Yeah.
You know, we've been thinking about developing an educational sort of platform based off of this, so that people can, you know, educate themselves. And, you know, what's behind it? Is there any, you know, no, but we'd have to go out and raise capital for it. And so you would then bring in the educational systems, and then you got to convince the universities and the schools that, hey, by the way, what you're teaching right now is obsolete, and it's been obsolete for 10 years. And if you really want them to survive when they graduate, they should learn this stuff. What I wanted to show you guys is an investor presentation before you go. How about we get a couple more minutes? All right. This is a company that I mentioned. We helped incubate them and seed them a year and a half ago. They've been part of the incubator since 2014. It's called FreeWire Technologies, and it's a few Stanford and Berkeley grads created this module that is a remote charging station, so it can charge anywhere. It could charge electric vehicles. It can charge the construction workers. That's why Black & Decker and Caterpillar invested in them. It can charge all of these different Hollywood sets and off-site disaster relief type situations. And what I want to do is just show you, you know, and their technology is actually not that disruptive, but they have relationships with Tesla and all that. And this is a really good investor deck. So they talk about the problem. So scaling the EV charging infrastructure is a pain, right? The solution. And this is, everybody wants to save money. If we can skim pennies off of pennies, right? That's when investors and everybody's like, oh, really? You can save on that? So we're going to be like, you know, scaling pennies very soon. Shows it as a service, shows the cost comparisons, the vision, growth, what it looks like an amplifier or kind of a DJ deck, subwoofer or something. All right, shows the charts. And it's not, the thing is you want to keep it short and simple, the KISS. Keep it short and simple. You don't want to overcomplicate it. Company timeline, boom. Customer traction, these are the customers that they have. And this was 2 years ago. So if you get customers, brand name customers, and all of these customers here, it wasn't their headquarters, it was their corporate venture groups. So it was the groups that were the old R&D, now are the corporate venture groups. Partnerships. Here's just basic, here's their pro forma and financials. Economics, the team, some of their press, and they ask, right? Boom. So it's really, now that took us a very long time to get that together. And then they have the teaser, the one-page teaser on that. So that's just the investor presentation. So the stage you would send the investor the teaser and you say, oh yeah, I'm interested. Can you send me more information? Then you send them the investor presentation. And he's like, yeah, we want to go into due diligence. And then that's when you send the NDA, and you never give anybody your secrets, right? And if they don't want to sign an NDA, then you don't want to do business with them. So, any other questions? Yep.
Yeah, the first thing you said is good luck if you're trying to raise money.
Yeah.
Give us like more information in real life and how long it would take and what,
Yeah, that's my answer. You know, I would say that everything takes longer times 10. So you really want to give yourself enough runway, and most importantly, it's not about the duration, but it's how much you learn through the process. You're going to get beaten up. They're going to laugh at you. They're going to ask you questions that you don't know. But but as long as you're getting better, then you're going to find the right partners, the right investment partners. Second, start with your friends and family as beta test, right? And have them grill you. It's not easy. It's not, you know, it's not an easy task. I will say this, if you're raising 250,000 to $1 million, it almost takes a lot longer to do that than it is to raise 25 to 50 million. Because what it means is that it's so early stage, it's just your idea in this room, and we're sketching it out. Whereas we're doing Series B and Series C rounds, 25 to 50 million, they're operating companies, and you have something to reference.
You mentioned that you do consulting for companies. What should you look for in somebody that you potentially want to consult, to be a financial consultant for you?
Somebody that's coachable. So I have 3 or 4 coaches myself, and actually 2 of my coaches are on my board. And so, and I like to coach because I then get to make sure that everything that I'm teaching and preaching, I'm doing myself. Somebody that has a vision that the market is big enough and that it's impactful. You know, whether it's saving the world or it's helping, you know, certain groups to save money and be more efficient to access this. But as long as it's not something that's heavy in its core being, and somebody that is a, you know, a hard worker, somebody that's focused, and something that, you know, we want to get behind. Usually, you know, I'll take on clients that, you know, either I'll throw some investment in and bring a syndicate in, because at the end of the day, if you have equity in that company, you have a vested interest in making sure they're up to snuff. And you know, I don't know if I mentioned this earlier, but it really is about relationship and how you relate, not only to your consultant and that type of relationship, but how you relate to the world and how you translate that relation and that sort of communication into different markets. Yep.
How do angel investors feel about businesses that are designed for cash flow rather than large exits? So not venture firms, but angel investors.
How they, for cash flow, right,
versus large equity exits?
I don't know the answer to that question, actually. They usually want to get out early. So angel investors want to sell out their portion before the big chunks come in. If they're looking, you know, venture investors, as you know, they look at it from a discounted cash value perspective. Whereas, you know, angel investors, it's like, you know, the term angel, it's a bit of an illusion, right? We all like, when is that angel just going to fall out of the sky and throw us $1 million because they believe in us, right? There are those, but they're very thin and far in between. Angel investors, most of the time, want to roll their sleeves up. They just sold they were ex-entrepreneurs. They sold their tech company and they're ready for something else. And so what I've observed is that there's a lot of founders out there that are almost addicts. They're like entrepreneur addicts, you know, just like drug addicts, right? They did this, right? And they sold their company for 10x and now they're off to the next thing. And so there's that portion of it, but then there's also angel investors want to get involved in a company that they don't know about. They don't have access to the market that they're looking for, but they know that they can bring strategic value and learn, because then their current portfolios could potentially be a match for, so I'm seeing that in the IoT space right now, in the clean tech space. Clean tech, we built this, so as I mentioned, I'm a tree hugger at heart. Clean tech and green technology we don't even call it green tech anymore. It's just assumed, right? China just announced that in 2020, all cars will be electric vehicle. So there is no clean and green anymore. I mean, there's Trump, but we'll put that to the side. But we can compare everything that Trump doesn't do to, what we're involved in. Anything else? Last one, and then we'll shut it
How
down.
common is it for founders to partially cash out somewhere in the rounds?
So founders can, so first of all, that's like, when you read about in the news that the CEO of Intel sold his shares before the earnings went to zero, right? And then there's this scandal. Sometimes, I mean, there are circumstances that founders obviously need capital, especially if they're not collecting a paycheck and it's been a long time, and et cetera. What you want to do is make sure that the founders what's the reason behind that? I mean, so some founders can sell their shares or a portion of their shares to future investors or current investors in that round. But you don't want to market that too much. So for instance, there was a time when we had a regulation issue and we had to change all of our development roadmap because the regulations changed. And so our next round of funding was we couldn't raise the money until we figured out what those regulations were. So I had to actually sell a little bit of my portion of my company to my current investor. He's a friend of mine, so he'll probably let me, off the hook at some point. But yeah, so each situation is different.
But generally it signals that.
Yeah, I mean,
It's not going anywhere.
look, the guys in Uber, the initial, investors in Uber, and those guys have been sitting, with paper unrealized gains for 12 years or however long it's been. They deserve, some pre-IPO type investments or some liquidity. So that's also brings up another thing, is that private equity is a long horizon. Most of the time, your company's not going to get bought in 2 to 4 years. Most of the companies are not like FreeWire, where you get an investment from BP Ventures and Black & Decker within 2 years. Most of the time, it's a long process. So you want to really bake in a long horizon. And, what I would suggest, if you're looking, I'm sure some of you have your development projects, and then you have your other ideas, and you're like, God, when do I make that leap? When do I go full time, and when do I build a team? And do a transition. Do it, take it slow. Nobody's going to steal your idea, and even if they do, then they opened up your market for you. Sometimes it doesn't pay to be first mover. Sometimes it pays. I mean, look at AOL and Yahoo, right? They were first movers, and whoever uses AOL and Yahoo, we all go to Google. Huh? Yeah, but you get to see what's out there, and if the market's big enough, then let somebody else open it up for you and see what those competitors are doing. So, all right, guys. Well, thank you very much. Thank you. And if you have any questions, you could just ping me on Facebook. Thank you.
What's the sustainable agriculture project you mentioned?
Yeah, it's vertical.